All right, so let's get started. Thank you all for joining us today for this podcast. I'm your host here, Guillaume Roux-Chabert with Interactive Brokers Singapore. So today our topic is about a very key component of the life cycle of equities, which are the corporate actions. I'm joined today by Stefano Grasso, portfolio manager of the Enhanced Value Fund, which is, by the way, also available in our marketplace for eligible investors. Stefano, thank you very much for joining us today. And let's dive in our topic directly with my first question. This topic is indeed quite timely because NVIDIA just announced a major corporate action with their split. So could you tell us a little bit more about it? And can you describe what corporate actions are and what they mean for a fund manager like you?
Yeah, sure. Hi, Guillaume, and thanks for having me. As you said, maybe let's, before jumping into the darling of the market, NVIDIA, let's step back a second and define corporate actions as events initiated by publicly traded companies that have the potential to impact the price of the securities, such as equities or debt. And with corporate actions, we have a very wide and big laundry list of actions. To simplify a bit for our audience, we can divide them in four categories. One is dividends and distribution, which are things like dividend declaration, stock dividend, special dividend, and things that are basically return of capital to shareholder, direct return capital to shareholder. There is then a second bucket, which is share capital alteration, which are stock buyback, public offering, private placement, stock option follow also on this category, stock warrant exercise, and so forth. Within this category, we have also the stock split, which I'll come back in a second about NVIDIA. Then we have a bucket, we can call it corporation reconfiguration, which are the spin-off, divestiture, merger, acquisition, liquidation, change of corporate structure, consolidation, joint venture. And these things are really material usually for the company. And finally, there is another bucket. Let's say everything that is not included in the buckets before, but are still meaningful actions like listing change, the listing, change of fiscal year. There are some peculiar, but still very interesting corporate actions that are interesting to notice and to take note about. Regarding NVIDIA, it was expected that the price action after the stock split. Usually companies do stock split when the price increase a lot and increase to a point where the retail investors struggle to buy one share because the price of that share has become like a price of a big home item or a big purchase. So they split it to give more liquidity to the stock. It's interesting because Warren Buffett and Berkshire Hathaway never split the stock. And since the 70s, when Berkshire Hathaway was traded, the compounding effect brought the stock price today to be in the hundreds of thousands of dollars per one share. Other companies, the majority of the companies, decide to split. And NVIDIA did the split. And usually when the stock that are, we can say in fashion, that are like the darling of the markets, they do the stock split, they generate price appreciation on the basis that there are more retail investor able to purchase a few shares. And there is often a cult with these companies, and therefore reducing the price of the share allow a much broader audience to buy into the share. So more demand for the shares, price goes up. NVIDIA has been going up despite of the stock split. The stock split was something that possibly helped even more the stock, even though from a financial perspective, it's like you have the same pizza, let me say, and you cut it instead of in 4 pieces, in 8 pieces, and the pizza is still the same. You're going to feed the same number of people. It's just that they're going to get 2 smaller pieces rather than a bigger piece, right?
Yeah, absolutely. That's a good analogy indeed. It's not only Nvidia, we have also Microsoft that is coming. That's for the stock split, like there was on the 10th of June. But obviously, you have other type of corporate actions, and you mentioned about them. But from your point of view, what is your approach to handling corporate actions, and how do you ensure like timely and accurate processing on your side? What happened after you receive these corporate actions, because they can be quite sudden sometimes.
Correct. The majority of the corporate actions happen, and especially the most relevant and important happen all of a sudden. So you don't get a notice. Like the stock split was announced a while ago, but that's more the exception. If you have the initiation of a share buy program or the payment of the extraordinary dividend, this happens without notice. So basically, you wake up a morning that the decision has been communicated to the market or is communicated during a earning release, and there is little you can do to do the work before. I have to say, certain corporate events are unspeakable. And if a company is trading a very cheap valuation, and eventually those two companies that were in the container lessor both bought out by two different private equities. So if you do, let's say, your homework, you can expect certain corporate actions to happen. If a company has a lot of cash on their balance sheet, you can expect them to do something with the cash, right? Maybe give a dividend, maybe start a share buyback, or maybe do some acquisition. So the key for us and the way with the colleagues within Enhanced Value Fund, we look at this situation is for both the companies that we have in our portfolio and the one that are on the watch list, we want to know them so well that whatever additional information come in, it's an additional data point that we can quickly process and take a view if you want to do something with that position. If we have in the portfolio, add, sell, do nothing. If we don't have in the portfolio, buy typically, or short sell if it is something really disruptive. So the answer is there is no secret sauce, but if you have done your homework on the company, you're just quicker to process the information and you can just take advantage. And actually, one example that comes to mind is one of our portfolio companies, IDT, which is a small cap US listed company that had a lawsuit, and we were expecting the result of the lawsuit to happen. The lawsuit was for 1.1 billion, and the market cap of the company at the time was 600 million. So potentially the lawsuit could have been very disruptive for the company. When the announcement came out saying that basically the lawsuit was dropped and the judge was saying there is no merit in this lawsuit, the stock traded up, I think, like less than 10%. But actually, that was a 200% potential impact in the stock price. So we were very clear about what that meant. We were able to add immediately to the position. And in the following days, stock did trended up and increased. And that's an example where you've done the homework and you can be quicker than the market, especially in a small cap company, especially in a crystal clear situation like the one I just described.
Excellent. Yeah. And it's good that you give this tip of do the homework and check on the cash on the balance sheet because it tells that the story might be happening. So that's a good takeaway for the audience. Maybe we can drill down a little bit with your extensive experience with the stocks and take maybe like one of the scenario of the corporate action, which is the merger and acquisition. So could you describe a bit more your experience with complex corporate actions with examples such as merger and acquisition, and how do you navigate these events?
Yeah, it's one of the probably most complex corporate actions because typically what happens when a company is buying another company or two companies are merging, there are a number of stakeholders involved. The boards of the two companies needs to agree on a certain level the details. Usually there are regulators, possibly several jurisdictions that need to come in and say if they agree or if they block the deal. A relatively recent one, but definitely high profile, was the acquisition by Microsoft of Activision Blizzard, the gaming company. And that deal took more than a year to finalize. And initially seemed that the UK regulator was not happy and that there were a lot of uncertainty. And the Activision Blizzard has been trading below the actual price that was known that Microsoft committed to buy it for the majority of these 15 months or so, that took the deal to close. Usually what happened in the simple case is that the stock price goes close to the purchase price and it stays there unless there are big disruptions. So these deals are very difficult, and there are a lot of also professional with insider informations, because you have a number of banks, lawyers, consultants working on the deal, and they might know something that you don't know. And sometimes you see some price actions that you wonder if someone knows more than others. And so it's very difficult. And for a retail investor or a small fund, you can't be sure that you know all the information to the latest extent, right? So this is the first point on M&A kind of activity. The second is that usually in case of an acquisition, the company that buys the other company has a negative price reaction because they're spending cash to buy another company. And typically the target company get a bump in price because, of course, to go private, you need to incentivize the shareholder to sell and so forth. But there are several exceptions to this rule, because sometimes, for example, when Warren Buffett buys something, the market says, this is a good news. If it is a good price for him, it's a good price for Berkshire. And therefore, even the company that actually lay out the cash is going to go up in value. You can't really do the usual trade, the short, the buyer, and go long the acquirer and basically the target company and basically make money. The information the market reacts sometime in different way. And on the merger, a friend of mine said there are never mergers. There are always someone being acquired and someone acquiring. And you see it usually when people that stays in the top position of which company fill the top spots in the merge organization. And it's very complex because for the culture of two companies can be very disruptive. And we recently have the merger of UBS and Credit Suisse in Switzerland. And basically Credit Suisse was handed almost for free to UBS. And UBS subsequently had the price appreciation quite substantial. There are lawsuits still ongoing for 81 bonds that have been wiped on the Credit Suisse side. And there are these lawsuits that are going to come to the merged entity at a later time. So there are a lot of percolation and permutation of subsequent actions that can happen that make that very difficult to assess at the beginning. And sometimes it just takes weeks to assess this specific corporate action.
We covered already the main corporate actions like the dividend, the stock splits, the merger and acquisition. What about the share buyback, which is also quite key and important? So each time in these situations, it seems like the key is communication, right? So how do you see companies communicating on their corporate actions? And do you see any differences between stocks and exchanges depending on their requirement? And what kind of level of transparency from them, if you have some examples?
100%. So I think it's an epiphany. It's a aha moment when a corporate action happens. Because if it is a meaningful corporate action, is basically the management of the company, the board of the company playing their cards. And the shareholders are getting the cards without having a say, unless there are then lawsuits and things like that. So it's very important for the investor to receive enough information to be able to assess the situation. And to your point about the exchanges, we invest in emerging markets in China. Even Singapore is much less advanced and transparent than the US in terms of disclosure. Canada is another example where the level of disclosure is not to the same level of the US. And that's part of the reason why the US is the most liquid market in the world and the biggest capitalization by far in the world. So definitely there is an element of exchanges and rules, but I think the management is always capable to clear uncertainty with a press release or a ad hoc conference. And I think oftentimes this doesn't happen. Even in the US, when excess cash is returned via dividends rather than buybacks, that creates a tax event for the receiver of the dividend, whereby in the buyback scenario, you wouldn't have a tax event for the investor. But because maybe there is a big shareholder that needs some cash, doesn't want to sell, they have just above 50% of the company, they don't want to lose control, they need the cash, and they trigger this dividend payment. And then the other investors saying, hey, you're pushing to me a tax event. Why are we doing this? And it's not always properly communicated. We really inquire hard on companies to be transparent. There are some change of jurisdiction, incorporation of the company. Tesla recently moved from California to Texas. So removed the headquarters for California to Texas. The incorporation was in Delaware, and they went to the other jurisdiction for not having Elon Musk pay challenged. And these things can be done in a very transparent way, explaining the reason, which, by the way, in Tesla case has been very transparent. Then we can discuss if the pay is too much or not, but has been done for that reason. In other situations, there are clearly some hidden reasons not explained. And I think that's what harm capitalism, because the small investor that maybe doesn't have the full understanding of what's going on get not delivered the full picture.
Yeah, but that's why we have IB and a flow of information for the informed traders, and that kind of podcast definitely helps. You mentioned about Berkshire, one of your favorite stocks. Yeah, I know that they never had a split since since they were issued, except they created a Class B, right? But is that because it's reflecting the strategy of the company, and you can read a bit into this corporate action as like a strategy statement from the management?
The majority of the things that Berkshire do are done in a very transparent and best practice way. The Class B was made for two reasons. If I remember correctly, it was explained in great details. One was that there is a thing like fractional shares, and basically some brokers used to take the big Berkshire Class A and split it in multiple shares and giving it to the investor that didn't have the full capital to buy one share. But doing that, they were charging an enormous amount of bid-ask fees and stuff. And Warren Buffett didn't like to have the small shareholder being penalized in that way. So that's one reason why he did the Class B. And the second reason was, as he's giving more control, as he's donating more shares to charity every year for 20 years, he's donating 1/20 of his net worth in Berkshire to charities. As he does that, he of course reduces the control that he has over Berkshire. And in order not to reduce the control, he basically converted the Class A shares into B shares. The Class B shares don't have the same voting power as the Class A shares. So basically, he dilutes the voting power of the non-Class A shares, therefore keeping the same amount of money that he's left with after these payments to the charities more meaningful in terms of voting power. So again, he's right to do within the boundaries of the law whatever he wants. Investors are free to sell or buy based on the information, but very, very transparently communicated, very transparently executed, and no surprises in that sense.
Interesting. Okay, thank you so much, Stefano. Maybe one last question to have a bit more sharing experience on these corporate actions. So can you give us like a couple of examples of recent corporate actions that were meaningful for the Enhanced Value Fund?
Yeah. So let me tell you two examples that are, I think, interesting for the audience. One is the change of the listing change. So we were invested in a shipping company that were listed in Oslo, and they were seeking and obtained a listing in the US. And the rationale for that for them was to give more visibility to their stock and to have them included in the pool of shipping companies that were listed in the US, where some ETF were tied into. You have the same underlying business, nothing changed, but the management wants to create more visibility for their stock. Interactive Broker also allow the Oslo Stock Exchange. We are both stockholders on Oslo and in the US stock, but many of the more mass markets brokerage don't easily allow to buy shares in the Oslo Stock Exchange. So that's a case of a corporate action that was, in this case, explained and is interesting because the liquidity of the stock in the US immediately picked up very quickly compared to the Oslo market. And that allow for a fund like us to be able to get in and out more comfortably because it's more liquidity. So that was one. And another one I find interesting is the change in fiscal year. With the fund manager friend of mine, we said, we want to look at all the companies that have the fiscal year not ending on the 31st of December and prove the point that we believe to be true, that they overperform the broader index or their sector. And the reason for that is that usually, and we saw it for our accounts, if you don't have the closing of the fiscal year on the 31st of December, as the majority of the company have, you pay less the auditors and the accountants because that's when the peak of the work is coming for everyone, right? So a company that has a fiscal year ending in March or even within the quarter, right? I think IDT that I mentioned before, they have it in May, some odd month, okay? When a company change the fiscal year, can be because they want to save on accountant fees and things like that. So a very noble objective. We support that. We like it. It's a bit more difficult to compare quarter to quarter with other companies. You need to do some adjustments. It's okay to pay the price for that if it is meaningful for the company. But there is also a risk because sometimes the company do that because a year is particularly good and they want to spread the year on different periods. So watch out when you say change in fiscal year and make sure that this is properly communicated because it can spell troubles as well.
Yeah, absolutely. All right, Stefano, we are reaching the end of this podcast. I want to thank you so much, dear Stefano Grasso from the Enhanced Value Fund. Thank you very much also for the audience for listening to this podcast, for the informed investors. I wish you all a very happy trading ahead. Thank you.
Have a great day. Bye.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. The information in this podcast does not constitute tax advice and cannot be used by the recipient or any other taxpayer to avoid penalties under any federal, state, local, or other tax statutes or regulations, or to resolve any tax issue.